Hello, everybody. Attorney Kevin Pritchett here for another episode of the Keeping It Real podcast, sponsored by the Law Office of Kevin Pritchett. Please know, legal disclaimer, this podcast is for general information, sometimes entertainment purposes only. It is not intended for legal advice, investment advice. Consult a licensed investment advisor or a licensed attorney for your particular situation. Now that we got that out of the way, we're continuing at the podcast series on the deadly money traps. I see these things over and over and over again in my 37 years of practice representing investors, individuals, businesses. These are the three killers of wealth. When you look back over your life and you ask yourself, why haven't I accumulated more? It's typically because you haven't dealt with these three things. And the issue today we're going to deal with is taxes. Now, here's kind of the common sense, keeping it real kind of observation about taxes. I have people running with their hair on fire, trying to get investment returns in the stock market. I want to get 6% return. I want to get 7% return, 10% return. Investors with real estate want to get 15% cash on cash return. And I guess in some spaces, that kind of 15% return is a large return. In the stock market, I think the average stock market return over the last 70, 80 years is right around 8%, 9%, something like that. Get this. Your federal income tax rate, if you're making any money at all, is anywhere from 27 to 36%. Then when you add the state income tax on top of it, if you live in a state that has state income taxes, you'll add anywhere from 5, 6, 7. In California, it's 13%. But you'll add another percentage on top of that, making the total tax burden, not even including fees and licenses and all that other crap, which is an additional, a different kind of tax. Your regular tax rate, your real tax rate, is well over 40%. Now just think about that. Over a 40% tax rate means that when you start working on January 1st, you don't get to keep any of the money you make until sometime in May, right? That puts it in perspective how huge this issue of taxes is on wealth accumulation. So, how do you address it? Well, before I get into how to address it, I want to talk about a little more about the implications of it. A good friend of mine is a very well-paid consultant. She makes about $200,000 a year. And she was contemplating in her annual review. She's very successful, very accomplished, has brought business to the firm, has kept business at her Fortune 100 consulting firm. And she was going in for her annual review. And she was talking to me about asking my advice about how much money she should ask for. And I told her, think about it this way. At your income tax bracket, almost every extra dollar you get of compensation, W-2 compensation, is going to be taxed at well over 40%. Her eyes just kind of bugged out of her head. That's the impact of taxes left unaddressed. I told her instead, rather than cash, because she really didn't need any more cash, I said, ask for stock. Why? This is a publicly traded company, very successful publicly traded company. Its stock has a very nice track record, has a nice history, and is likely to grow substantially over time. The advantage of having your wealth grow as stock in a publicly traded company with an actively traded stock is that the gain on that stock is deferred. And if you do it right, you will never have to pay tax on that gain. So let's say rather than getting $50,000 or $25,000 of extra bonus compensation, which is going to be taxed at well over 40%, you got the equivalent in stock. You don't pay any tax on that stock. You may pay tax on dividends if that stock generates dividends. But let's say the stock doesn't generate dividends, or if it does, you have dividend reaccumulation that is used to buy more stock. Again, you'll have an incremental tax bill on whatever the dividends were for that particular year. You know, much better to pay a current tax on the small dividend yield than on the entire $25,000. As that stock grows in value, you literally have more wealth accumulated, but you're not paying tax on it. Let's say you never need that stock. You can pass that stock on to your heirs, and they get a tax preferenced basis on that stock. Long story short, they won't have to pay tax on the stock that they receive either, and they can continue to hold that stock and accumulate it forever. As I've talked about in other podcast episodes, there's 3 tax buckets: the tax now bucket, the tax later bucket, and the tax never bucket. In this example, if you were to receive compensation in stock, then that stock would accumulate without you paying tax on that accumulated gain, and you could conceivably defer that gain forever. So at the best, you could put this stock example in the tax never bucket, but worst case, you put it in the tax later bucket, and you end up with substantially more wealth using this strategy, for example, in compensation, to receive compensation, rather than getting a paycheck. So my friends, do not sleep on taxes. You get your hair on fire about getting a 1% increase on your stock market crap, and you're paying over 40% taxes on it. Rather, focus on generating your wealth in strategies that are in that tax later or tax never bucket. If you have questions about what these strategies are and how to apply them for yourselves, or you want an analysis of your situation, sign up on the link below for a one-on-one consultation. That's exactly what we do here. Analyze people's situations, let them know how they can position themselves much better for wealth accumulation. My friends, that's all for today's Keepin' It Real podcast. Until the next time, Kevin Pritchett signing off.